Thank you for joining us for the second installment of MPERS webinar series. In this installment, we'll be talking about the system's funding. It's called the Funding Update, and we're essentially going to find out what is the financial status of MPERS. My name is Jamie Mullen. I'm a benefits specialist here with MPERS. I specialize in retirement and disability counseling. And before we get on with our webinar, I'd like to point you to a tool that you can engage in on our website. It's called Education on Demand. So from our homepage, mpers.org, on the right-hand side, there's a menu item. The menu item that you'd be interested in is called Education on Demand. And if you click on that, you can view not only MPERS' webinar series, but there's also some introductory videos to the basics of the benefits that we administer. So that's our key message with this webinar, is the funding status. We want you to know and understand the financial condition of MPERS. Obviously, it's important to you to learn when you become eligible to retire, how much your retirement benefit will be. But I imagine it's also important for you to understand how this benefit is funded. So what I'd like to do now is pass this over to our presenter. His name is Scott Simon, and he is the Executive Director of MPERS. Here you go, Scott.
Thank you, Jamie. And good day, everyone. I appreciate you taking the time out to spend a little time with us today to get an update on our funded status and what it means to fund a defined benefit that most of us enjoy through MPERS. This is a very complicated and detailed discussion, or at least it could be. But for today's purposes, I'm going to try to keep it very high level and just cover a few basic details that I think will be important to you. And of course, we always welcome questions on any topic or subject matter related to what we do here at MPERS. So if you have additional questions, feel free to contact us. But for today's purposes, our objectives are essentially four things. One, we're going to identify what measures MPERS financial status. We're going to explain MPERS annual valuation. We're going to find out what MPERS funded status is. And then we're going to close with, well, why does it matter? So, what is MPERS financial status? Well, there could be a number of things to consider or use to answer that question. For today's purposes, we're going to use what we call the funded status as our barometer. Now, the source for that can be found through our annual actuarial valuation report that our retained actuary, GRS, provides. That's a report that's available on our website. Anyone can take time out to take a look at that. In fact, I encourage everyone to look at that report. Now, the first roughly 15 pages of that report, I think, provide a pretty good layman's explanation of the funding of our plan. I strongly encourage you to take a look at that. And while it's 15 pages, it includes a lot of charts, so it's not maybe as much reading material as you might think, but I think it would be worth your while to spend a little time giving that a look. For other financial reporting information, I would refer you to our Comprehensive Annual Financial Report. We often refer to that as our CAFR. That too is available on our website, and it includes much of the information that's in our valuation, but it goes much further than that and talks about things like our budget, for example, our assets, and various other things. So I would encourage you to give that a look as well. But for today, let's get back and let's focus on the funded status and what does it mean. Funded status defined is the ratio of assets available to cover the cost of the benefits earned. So the objective is to have 100% of the assets needed to pay for the benefits that have been earned. So what is MPERS funded status? It's 55%. So in other words, based on that definition, we have just a little over half of the assets available to pay for the benefits that have been earned. So is that good or bad? By itself, you might think 55% doesn't sound too favorable. And it likely would be viewed that way by most. However, before this presentation is over, hopefully you will see that the funded status alone is not always sufficient to answer that question. So let's talk about how do we determine the funded status. The funded status is just one product of what we call our annual valuation. The annual valuation is performed by our retained actuary that I mentioned just a moment ago. So annually, the actuary performs our valuation, which is essentially a financial checkup of the plan. The purpose of the valuation is essentially twofold. One is to predict the cost of future pension benefits, and the other is to determine what level of contributions, when combined with investment income, is needed to provide benefits over the long term. There's a basic formula that we often use to help individuals and members and stakeholders understand the basics of funding a plan like MPERS. Now, I'm going to go back again for just a moment and say the process of the valuation process, that is, that our actuary will go through, is extremely detailed. In fact, I'm not even going to begin to try and describe that to you, but at a very basic level, this formula describes sort of what the actuary is getting at, and you can see the C plus I equals B plus E, where the C is contributions, I is investments, the B is benefits, and the E is expenses. Now, I'm just going to focus on the left side of the equation primarily, but I will say this. Generally speaking, the C plus I are what we would refer to as the assets of the system, where the B plus E, we would often refer to those as the liabilities, the benefits earned, or the liabilities of the system, the money going out. But just to give you a sense of how the equation works on the left-hand side, on the C plus I, the contributions are set through the valuation process, and we rely on investment income to pay for a significant portion of the benefits that we enjoy. So if we don't get as much money in from our investments, in other words, if our investment return is not where we would like it to be, then what happens to balance out that equation, we have to have higher contributions from our employers and from our employees under the 2011 tier, where the employees do make a contribution. If investment income is actually higher than we would expect it to be, then the contributions from our employers could actually drop. Now, we'll go into a little bit more detail on that, but that gives you a sense of how the funding equation works. Now, on this page, there are a lot of details and assumptions listed here that are associated with the valuation process. I'm only going to focus on a couple of things and try to explain them to you, and those things are, first, I think I'll focus on the investment rate of return, because that's something most of us can get our hands around. For the funding equation, our assumed investment rate of return is 7.75%, so 7.75%. We assume that every year that's the number that we will realize in terms of our investments. Now, we understand that is not going to happen. That is, it's not going to happen every year. Keep in mind that 7.75% is a long-term number. We're a long-term investor. Generally, we think of ourselves as a 30-year time horizon. It's not out of the realm of possibilities here. So we're a long-term investor, but we understand that every year, while we're shooting for that target, we're not going to get there. And for example, this last year, we fell short of the 7.75%. The expectation is that we'll hit that number, and when we don't, when we fall below it, that would be considered a loss. Anything above 7.75% is actually a gain, but anything below 7.75% would be considered a loss. Now, that may throw you a little bit, because I think generally most of us think, well, if you're below zero, then you've had a loss. For funding purposes on MPERS, anything below that assumed rate of return would be considered a loss. And going back to the C plus I equation, if we're not getting the investment return that we expect, that would tend to drive the contributions from our employers up. Now, the only other detail that I really want to spend a little bit of time on here is up here at the 3-year smoothing under the valuation method. We use 3-year smoothing, and what that means is, rather than acknowledging those gains and losses that we might have immediately as they occur each year, we actually will take those gains and losses and smooth them over a 3-year period. In other words, if we have a gain one year, we will take a third of that and we'll distribute it across the next 3 years. Same thing if it's a loss. We will take a third of that and distribute it across the next 3 years. And the point of that is to simply diminish the volatility that we would otherwise experience in our contribution rates if we assumed, or if we recognized rather, those gains and losses immediately. So that's just something to help our sponsors, our employers that we cover through their budget process, so their contributions are not up really high one year, down the next, and so forth and so on, based on investment returns. So that gives you a little more detail and flavor for the assumptions and methods associated with the actuarial evaluation process. So, why is MPERS funded status low? Well, a short answer is we did not pre-fund all benefits until 1999. A longer answer includes a list of oversights and changes and other things where the plan just simply wasn't funded appropriately. For example, we were funding benefit enhancements on a pay-as-you-go basis. Now, normally when you think of a pay-as-you-go system, you think of Social Security. And we all know the condition of Social Security today. That's not the ideal approach to funding a future retirement benefit. We are supposed to be a pre-funded plan, but we had, for whatever reasons, a number of benefit enhancements over the years that were on a pay-as-you-go basis rather than pre-funded. Now, I can tell you, since 1999, all of our benefits have been pre-funded, so we're catching up. But that set us back a bit because of the pay-as-you-go status on a few of those things. We had a conservative investment history. We actually did not have dedicated investment staff in MPERS until 2003. So up until that time, we really were trying to protect our assets, very conservative investments, rather than trying to grow them. Today, we have dedicated investment staff with the expertise to manage our funds and try to grow them rather than putting them into something like a CD, for example, that has very minimal opportunity for growth. May be solid in terms of keeping your money, but you don't see a much investment return on that. There were a number of actuarial funding methods used over the years that really didn't help our funded status either. Such things as extending amortization periods, and I'll talk about that a little bit more here in just a moment, where we extended amortization periods to pay down the unfunded liabilities of the system. So it's rather than addressing our funding shortfalls, we tended to spread it over more years. And then lastly, of course, everyone knows for the last decade or so, we've had significant market downturns. We had the tech bubble in 2001, and then more recently, the Great Recession in 2008 and 2009. All of those things played a role in getting our funded status to where it is today. So are there solutions? What are we doing to address the low funded status? Well, there are three things that I would point to that have been done in the last decade to address our funding shortfall. We have our permanent funding policy, a temporary accelerated policy, and then we have the contribution rate stabilization reserve fund would be the latest one. Now, let's talk about each of those individually. The permanent policy was created back in 2006. And at that time, the Board of Trustees stepped back and realized that our funded status was not ideal, and that something needed to be done to address it. So they created what we call our permanent funding policy. And essentially what they did was take and start funding our unfunded liabilities on a closed amortization period rather than an open amortization period. So let me use an analogy here. Most of us have a home and we used a mortgage. Many of us used a 30-year mortgage to pay for that home. So the amortization schedule is tied to our unfunded liabilities is very much like that mortgage. So for years and years, we used an open amortization period, which means that every year it was like we refinanced back to 30 years. We never whittled down to 29, to 28, to 27, so forth and so on. It was an open 30-year amortization period. Now, believe it or not, that actually would ultimately result in paying off your unfunded liabilities. But it takes a very long time to get there. So the board in 2006 realized that wasn't going to get the job done, so they closed the amortization period and made it a 30-year amortization period to cover our unfunded liabilities. So like the mortgage on your house, it would come down 1 year each year until ultimately, after the 30-year period, you have paid off your unfunded liabilities. As of July of next year, that period is down to 19 years, so we're making progress. Now, after the Great Recession rather, in 2008 and 2009, the board realized that we took a major hit, of course, as a result of the market decline there. The board realized that the permanent policy really wasn't sufficient to get what we needed done. So the board made a decision to accelerate the policy in the form of this temporary policy and address retiree unfunded liabilities over a 15-year amortization period and all other liabilities over a 30-year period. So that policy is in place today, and as we speak today, or July of next year actually, the amortization schedule for that will be down to 8 and 23 years respectively. And that policy will remain in place, the temporary policy that is, will remain in place until such time that the permanent policy would actually provide a larger contribution rate. Now, you and I don't really see that so much. Our actuary is the one that behind the scenes in that valuation process is applying both of those policies. And at some point in the not so distant future, we can probably expect that the permanent policy, somewhere in 5 to 10 years, will resume and the temporary accelerated policy will go away. Now, last but not least is what I will call the we'll call the reserve fund. And in 2014, we had enjoyed several years of pretty nice investment returns. And we were in a position actually to lower our contribution rates. But nobody was really expecting that to happen at that time. So we approached the board, and the board decided that, you know what, we're not going to lower our contribution rates. We're going to keep them where they are, and we're going to take the balance, which is in the form of this reserve fund, and we're going to set it aside to maintain these higher contribution rates, and we're going to use this reserve to protect us for downsides in the future. Now, the maximum level of the reserve fund is $250 million, and we're actually at $188 million today. So we've got a little bit of cushion in there now. We're a $2 billion fund, so it doesn't take a lot of deviation from the market to use up several million dollars. But at the moment, the reserve fund is actually going to protect our employers from higher contribution rates, anything above 58%. And you'll see here in just a moment a little bit better what I'm talking about. But the reserve fund seemed like a very good choice at the time, and it is serving us well at the moment because we are in what we expect to be a low return environment. And again, I'll talk about that in just a moment. So those are the three policies that we have in place that are geared towards addressing our lower funded status. And earlier you remember that I said that before this presentation was over, that hopefully you would recognize that just the funded status number alone really wasn't sufficient or isn't sufficient to say is a plan adequately or is favorably or poorly funded. By itself, 55% doesn't sound so good. But when you incorporate these aggressive funding policies, and these are very much aggressive funding policies, we're in a pretty good spot. We're making progress, and I think you'll see that in just a moment. What differentiates us from some of the other public pension plans that you often hear about in the press is those plans may have a funding shortfall very much like us. They may have a funded status very much like us. The difference is our employers are making 100% of the contributions that the actuary recommends, and we have aggressive funding policies in place. That's what separates us from some of the other systems that you might hear about. And I'll use Illinois for an example. They have very significant shortfalls in terms of their funding. They don't have the policies in place to deal with them. That's what separates us from them. So by itself, the 55% may not seem too good, but realize that we do have aggressive funding policies in place, and they are working. It just takes some time for them to do their thing. So we're talking about, have we made progress? And I think you're looking at this chart that you can see that we have. So you can see the trend here from about 2010 through today. Our funded status low was just over 42%. In just a few years' time, we're already back up to 55.5%. That's not a fluke. That's a function of the aggressive funding policies that we have in place. They are working. In fact, I don't think many individuals that are following the system would have expected our funded status to increase this year because, as I pointed out earlier, we actually had a loss relative to our assumed rate of return. But because of the aggressive funding policies that we have in place, we actually did see our funded status go up. Now, can you expect this to continue? Well, you can, but don't expect it to be a trend consistently going upward. There will undoubtedly be points in time, and probably in the not too distant future, where the funded status will drop backwards from year to year. Ideally, that wouldn't happen, but the markets don't always give us positive returns, and when the returns are not what they need to be, that does set us back in terms of our funded status. But over the long term, you should see a continued improvement in our funded status. So what does the employer, or what do our employers pay? Everybody knows that MoDOT and the Highway Patrol are our covered employers, and their current contribution rates are at 58% of pay. That should strike you as a very high number, and it is. And it's an extraordinary number that our employers have to pay for the benefits that we enjoy. But let's look at it just a little bit more detail. Here is a chart from our most recent valuation, and you can see here that our population, our covered members, are broken into two groups. Essentially, we have a non-uniform group, and then we have the uniform patrol group. I'm not going to focus on those individually, but rather I'm going to focus on the combined rates. So this is the everyone put together, and go over the components here that make up our 58% contribution rate. First, you have the normal cost at 11.72%. You have the unfunded liability at just over 44%, and then expenses, that's the administrative expenses associated with running the fund at 1.2%, gives you this total, and then we'll add on our disability insurance to get us to the 58%. Now, folks would look at that and say, well, you've got an extraordinarily generous or expensive benefit plan. Well, not so fast. The 58% by itself might suggest that, but what you've got to explain is that the lion's share of our 58% contribution rate is what I'll call our catch-up payment. That's the unfunded, or the funding shortfall, the unfunded liability associated with the benefits our members have earned. So you can see it makes up the lion's share of the 58%. The real cost of our benefits is the normal cost here at just under 12%. That number seems much more reasonable in the grand scheme of things, and that's the cost of the benefits that we enjoy, and it's a much smaller component of the 58% than the unfunded liability. And that number actually should go down over time as we have more and more members into the 2011 tier, which has slightly less generous benefits than the closed plan and the year 2000 plan. So make sure that you understand the components of the 58% contribution rate, and realize that by far the catch-up payment for the funding shortfalls of the past are what represent the majority of that contribution rate. Now, let's take another look at our contribution rates. Here you can see on the right-hand side of your screen, essentially since 2014, when we created the reserve fund, that our contribution rates have been very steady at around 58%, and ideally that will continue for the next few years. Again, that's subject to what experience we actually have in terms of investment returns and other things. But for the moment, the reserve fund is doing what we had hoped. It's maintaining that level contribution rate, and hopefully will protect us for the low return environment that we think we're in for the next few years. So why is all this important? Well, obviously our employers who are paying the lion's share of this benefit must have an attractive and reliable benefit to facilitate their recruitment and retention efforts. If it's not serving that purpose, why do we have this? So it's a very important component of the benefits package that we as members enjoy, and as employees of MoDOT or the Highway Patrol. The other thing is that the benefits that we as members enjoy are based in statute, and are, once they're earned, the view is that they can't be taken away regardless of what our funding status is. Nonetheless, it is important to our members and our stakeholders that we have confidence that they can rely on these benefits. So at a 55% contribution level, or I'm sorry, a 55% funded status, that doesn't always give you the greatest confidence. So we're working to improve that number, and you should see that number improve over time. And then, of course, lastly, the taxpayers of our state must find these benefits and the associated costs reasonable. So a couple things I want to leave you with, and that is the future funding. We are, as I've said numerous times today, in what the economists and our consultants would say is a low return environment. Now, what does that mean? We're not exactly sure. Only time will tell. But we do believe that the low return environment that we're in will probably fall below our 7.75% assumed rate of return. And if that happens, that's going to put funding pressure on the plan and our employers. That's not a surprise. That we all know that the markets go through spells where we have very high returns, and then we'll have very low returns. We happen to be in a low return environment, which doesn't help our cause, but we are, as I remind everyone, a long-term investor. So the short term, while it is important to pay attention and make minor modifications to things, we have to make sure we keep a long-term perspective here. And again, I'll go back to that 30-year time horizon is the horizon that we often use when looking at our investment returns and our asset allocation. About a year from now, we will begin our next experience study, and it would be produced probably that following February. So after our next fiscal year, we'll start that process. And the experience study is a very detailed analysis of all the assumptions associated with funding our plan. It's the assumed rate of return, and it gets into much more detail on the liability side, the benefits earned side, where it's looking at things like mortality. Are we living longer? If we're living longer, that tends to put funding pressure, or I'm sorry, additional cost on the plan, and that too tends to increase funding pressure on the plan. So that's something that's coming up next year. So you don't want to be surprised by that, and you might want to be looking for those results when they come out to see what, if any, changes are made to our funding assumptions. If there are changes made, it will likely put additional funding pressure on the plan. And then lastly, I would just simply say have measured expectations. So often I've heard our investment consultants say have tempered expectations in the coming years, because we're not going to see the same high returns that we've enjoyed for the last several years. They're going to be much more moderate. So we have to be mindful of the environment that we're operating in, and again, realize we're a long-term investor. We're a long-term entity. A few years here that might set us back a little bit, we'll recover from. We're in a good position to weather those time periods with the policies that we have in place. Now, earlier on, we listed these objectives, and I'm just going to go back over them very quickly. So first, what measures MPERS financial status? As we said, there are a number of things that you could look at, but for today's discussion, we looked at our funded status, 55%. By itself, it may not look that good, but if you go back and look at our history, you can see that we've made considerable progress over the last several years. And we have the policies in place to make sure that continues, or that when we have market environments like we're expecting, that we can weather those sufficiently. So we explained the MPERS annual valuation process. The annual valuation is what determines our funded status and our contribution rates each year. We've just very much touched that at a high level. There's a lot more detail there, and that's where I will refer you back to the valuation on our website. And look at those first 15 pages. It really won't take you long to browse through that and have a much better sense of what the valuation process looks like and the results that come from it. What is MPERS funded status? Again, we talked about that. It's 55%. We talked about the policies. And then why does it matter? We just hit all those things. It matters because our employers want to have a sufficient recruiting and retention tool. Our members want to make sure they can rely on the benefit, and the taxpayers want to make sure that they're getting a reasonable benefit for the pension plan. And with that, I will end the funding update and turn it back over to Jamie.
Thank you very much, Scott, for that informative presentation. I would just like to remind our members that MPERS.org is a valuable tool for all information regarding your MPERS benefits. You can also email questions to MPERS@MPERS.org, and there's always a benefits specialist here that's ready to assist you. And also stay tuned for future webinars. We've already done disability and funding, and now we're going to get into the retirement benefits. So thank you very much. Have a nice day.